Hello, everyone, and welcome to Panel 5 of the Central Banks and Digital Currencies Annual DMI Symposium. The panel today is on global cross-border payments from target to execution. I have the esteemed pleasure of introducing my perfectly suited panel to share with us the latest thinking on cross-border payments. We have Tommaso Martino Griffo, Division Chief from the Monetary and Capital Markets Department at the IMF, Chad Harper, Global Payments Fellow at Visa Economic Empowerment Institute at Visa, James Wallis, Vice President of Central Bank Engagements and CBDCs at Ripple, and Kieran Murphy, Member of the Secretariat from the Financial Stability Board. Welcome to you all and to our attendees from across the globe. So today we have the very small task of unpacking the trillion-dollar cross-border payment sector, which is ripe for disruption due to changing consumer demands, emerging market growth, and financial inclusion, and so on. It's really this hidden plumbing system that continues to be used so much, and it's so essential. But we're seeing so much change evolving, specialized players coming in, innovative solutions, tackling some of the traditional pain points, as well as now potentially the public sector bolstering its role with its CBDC exploration. So we'll start by looking at how to improve existing infrastructure, and then we'll go on to some of the new innovations. But before we begin, just wanted to tell all attendees that we are running some polls, which you can vote on in the chat box on the swap card. The first one is, will the role of non-bank institutions grow in cross-border payments, and does this create new risks? Yes, and the risks will increase. Yes, but it won't create new risks, and no. And then the final one is, can CBDC solve existing challenges in cross-border payments? Yes, no, or too soon to tell. So let us know your thoughts and we'll factor them in. So to kick us all off then, Kieran, I'd love to start with you first and all the extensive work that the FSB leads on. What are the pain points that the FSB has identified in the current system, wholesale and retail, and how are you aiming to address these?
Okay, well, firstly, thank you for the invitation to participate on this interesting panel. It's a very important topic, as you've mentioned, and that's a great question to kick off this discussion. So I'm going to give you a bit of a history lesson first. Back in April 2020, which seems a lot longer ago than it should, based on everything that's happened since then, the FSB published a Stage 1 report on enhancing cross-border payments, and we highlighted 4 main challenges faced by cross-border payments. There being high cost, low speed, limited access, and insufficient transparency. And yes, these affect end users and service providers, but it's important to note that they don't affect them all in the same way. So individuals and small companies face particular problems, especially when we talk about retail cross-border payments. And this is a real challenge for many people. And it's also noted that low-value payments may incur high fees as a percentage of the amount sent, and they face cumbersome processes with existing systems. So in order to address these challenges, the FSB, in coordination with the Committee on Payments and Market Infrastructure, so it's the CPMI, and other relevant international organizations and standard setting bodies, developed a roadmap. And the G20 leaders endorsed this at the very highest level at their November 2020 summit. So the roadmap consists of 19 building blocks across 5 focus areas. And these focus areas are, firstly, a commitment to a joint public and private sector vision to enhance cross-border payments, and very important that both work together. Second, coordination of regulatory, supervisory, and oversight frameworks. Third, improvements in existing payment infrastructures and arrangements, as you mentioned. Fourth, increased data quality and straight-through processing by enhancing data and market practices. And fifth, more exploratory, more futuristic-looking work, looking at new types of payment infrastructures and arrangements, for example, central bank digital currencies and also stablecoins, and what these could play in delivering better cross-border arrangements. Now, each building block that we've created has specific practical milestones. They're set out in detail in the roadmap document, and it acts as an international commitment device, although it is a multi-year project, so it needs to remain flexible and adapt to changing circumstances. So this has been in place since October 2020, and in the 18 months since, the bodies responsible for taking forward the various actions, and we have identified this in the roadmap, which bodies are responsible for which action and which building block. They've been working on implementing the roadmap. And for that period, it's mainly focused on laying the foundational elements for the future roadmap actions. And a key part of that foundation, which I think we'll touch on later, is what has been completed under the first building block, which has been the publication of specific targets at the global level that quantify the roadmap's goal of addressing those challenges that I already mentioned. And this was published in October 2021. So these targets play an important role. So they define the ambition of the work, and they create accountability, and they provide a common vision for the improvements that we're trying to make under the roadmap. And private and public sector involvement and action will be key to achieving them. And it's important to note in answering your question that these cover the wholesale and retail market segments, which we have specifically defined in the targets report, as well as remittances. So these targets were subject to public consultation earlier in 2021, and the individual public responses that we received have been published on the FSB's website, along with an overview of those responses as a summary. And so the targets will be made operational in 2022 through the development of the implementation approach to monitoring progress towards them. This is being worked on currently over the last few months, and it is most certainly not an easy task, as there are few existing data sources that measure the current state of play. But even beyond this, if you look at the other 18 building blocks, there has been an awful lot of work, including publications, in fact, today by CPMI. And I can't overemphasize the sheer breadth of the work underway. And taking forward these building blocks simultaneously has been and continues to be a major exercise for all those authorities that are participating in them. But the other thing is that there has been regular engagement between public and private sectors throughout this period. And we've had international conferences, workshops, surveys, publications, bilateral discussions. So there's an awful lot of work going on. And finally, the last point I'd like to make on this is that the FSB has committed to publishing a consolidated report each year to report on progress, so that people are aware of what's happening on all of these building blocks. And also as an opportunity to review the actions and timelines to make sure they remain appropriate, because as I mentioned, this is a living document, and as the situation develops, there may be cases where these actions and timelines need to be adjusted. So the first progress report was published in October 2021. This can be found on the FSB's website, and this shows the milestones achieved during 2021, and it confirms that the actions that we've committed to for 2022. So I'll stop here. Thank you.
Thank you, Kieran. That's an extremely useful overview, and I do not envy your impossible task. But Chad, I mean, you're someone who I think studies these regulations and all these supervisory targets a lot. What would you say to Kieran on some of the targets that they've set out for cost, speed, access, transparency? What would you suggest as KPIs in the long run?
Thank you, Katie Ann, for that question, and Kieran for that overview of the roadmap. My colleagues at the Visa Economic Empowerment Institute and I share in the aspiration of making cross-border payments work better for everyone. This is a topic we've spent some time on since we were founded 2 years ago. And of course, my colleagues at Visa have been working for 6 decades to create a globally functioning, seamless retail payments capability. We're supportive of the roadmap's goals and have engaged with the FSB, CPMI, and World Bank colleagues on several of the building blocks already, and we plan to be engaged in many of the work streams moving forward, and we welcome the opportunity as Kieran described, to engage on these work streams. When it comes to building block 1 and the quantitative targets that were established last year, I want to acknowledge the complexity of what the FSB is undertaking in having set these aspirational targets for wholesale and resale and retail, and maintained and built on the remittances target, and now in working to figure out how to measure and report against all of this. In some respect, the targets are a bit easier to think about for wholesale and remittances. Wholesale is, as defined, as basically an interbank use case of large value flows, and remittances are also basically a single use case, and aspirations for them have been well known for years as part of the UN Sustainable Development Goals. Things get trickier for retail, where these aggregate targets have been applied across several use cases, which can differ. I apologize to Kieran, who has now heard me say some version of this 3 times in 2 weeks. We believe that security and resilience are foundational to payments, and this, of course, applies to cross-border payments. Security and resilience build trust, and we might have liked to see this reflected more overtly in the targets, lest anyone get the impression that trade-offs are in any way acceptable here. But outside of security and resilience, users may reasonably want different things from retail payments depending on the situation. In the case of two businesses who have a trusted working relationship, if one needs to send the other $5 million across borders, a fairly simple push payment will likely work fine. But if a consumer is making a $200 e-commerce payment with an overseas merchant they've never dealt with before, they may very reasonably choose a payment method that offers them more value than simple money movement, perhaps in the form of well-known dispute resolution mechanisms and consumer protections. And these distinctions could be made across all of the use cases in this very broad, heterogeneous retail category we're dealing with. So what do we do about this? Well, I'm assuming that FSB set the retail targets in aggregate fashion so as not to go down many rabbit holes that would result in our having dozens sets of targets. Totally understand that. I would hope, though, that as the FSB members and staff work through how to talk about these cases, these use cases in their reporting, they'll acknowledge that not all payments are the same and that motivations vary. What's really important to users can vary, and people may reasonably opt for higher value payments in some cases. And these payments aren't comparable to simple money movement. So as long as we acknowledge this, we will avoid deciding what is important to people for them. A brief point on speed. Within the aggregate target set for retail, diversity of cost and speed should be expected across different use cases based on what people want and need. Should we do the work to enable payments to be faster while still ensuring security and reliability? Yes. Should we set the expectations that all payments have to be fast for all use cases? I would say no, and I hope the targets will not be used to foreclose informed user choice. One more wish for KPIs, further improving cross-border payments, the aspiration we all share, will depend on many of the other building blocks bearing fruit, and Kieran described those building blocks. Many of the building blocks are aimed at streamlining regulatory issues to reduce frictions. We think the work being undertaken in focus area B of the roadmap will be super important for enabling further improvements to cross-border payments. And this work is very difficult as it requires substantial multilateral cooperation. There are also a variety of building blocks intended to improve existing infrastructure and explore new solutions. So I'd certainly love to see KPIs that somehow tie progress on those building blocks to expectations of making progress towards the targets. Thank you, Katie.
Thanks, Chad. Kieran, do you want a brief response before I turn to James and Tommaso, if you wanted to add anything?
Well, as Chad mentioned, we've had a few of these discussions previously, and certainly it's something that we take account of. One of the key points we've made, because it was one of the questions that was raised when we were putting together the targets, was, are these mandatory targets? These are where we want to be, and we are fully cognizant of the fact that a lot of this depends on a lot of the work that's going on the other 18 building blocks of the roadmap. When it comes to the aggregated targets themselves, we've allowed for the fact that there are certain percentages that are not going to be. For example, if you look at speed, we have 25% that would not be within an hour, for example. So we have allowed for that and taken account of the feedback we received when we launched the consultation last in May 2021. The feedback that we received from industry about the targets that we were setting.
Thanks, Kieran. I just want to let panelists know we've had some results back from the poll. 72% of people think that risks will increase from the role of non-banks in cross-border payments. So let's take a closer look at the roles of the public and private sector. James, if I could start with you, I think clearly we've got a lot of new players, yourself being one of them, although you're very established now, seeking to address some of the challenges that Kieran and Chad have raised. There's massive liquidity problems, which is listed as one of the root causes of cross-border payment issues. There's so many players, Finality, Ripple, yourself, RTGS Global, everyone's coming out with all these solutions, a lot of them non-CBDC as well. What What do you see as the changing dynamics between the public and private sector in upgrading cross-border payments, and how have they shifted, from in the last 20 years or so?
Yeah, thanks, Katie Ann, and thanks for the invitation here to join the panel with my colleagues. Yeah, it's a good question. I think the really most of the initiative that we've seen is coming from the private sector. I mean, I think the public sector has a role to play in engaging in the conversation, getting the topics discussed, like Kieran described. And I think the four areas of focus that Kieran mentioned are actually, those are the same objectives that, as an example, Ripple with RippleNet are set out to achieve, right? So lower costs, faster, more transparency and greater access. And I think one of the big questions here is, what happens with the correspondent banking model? I think the role that the banking system plays is crucial in the global economy, and I think that will continue. But the sort of traditional model of, pre-funding accounts, for liquidity purposes, nostro vostro accounts. I mean, it's proven that part of the correspondent banking model is not needed. Just to give you an example, within our RippleNet offering, we have sort of two options. One is fiat money, which is being used through the whole system, and that still does require some pre-funding. And then we have something called on-demand liquidity, which negates the need for pre-funding. That uses crypto asset as a bridge mechanism between one currency and another. The run rate on that is we're definitely not at the trillions of dollars at this stage, but the run rate is over $1 billion per month with that particular offering. So that's sort of driven through technology. I think I'd love to see more collaboration with the public sector around these kind of innovations. I think part of it is education. I think part of it is there's still an inconsistent perspective on crypto assets globally from a regulatory perspective, and we're pushing hard to try and get better regulatory framework. I mean, there are other solutions, right? As you mentioned at the start, KDN, stablecoins will play a role. I mean, really, functionally, stablecoin and a CBDC very similar, right? It's obviously backed differently, but in terms of what they can do for a payment system to mitigate the need for pre-funding. I think that's got huge potential. The other point I would make is when we look at cross-border payments, which is really how Ripple started, we had a big focus initially on remittances and looking at providing low-cost remittances. Mostly, the traction we got was with non-banks, so other financial institutions, so payment providers, PSPs. Money service companies, whatever label you want to put on them. But we have seen increasingly through this on-demand liquidity capability, we've seen an increase in treasury use cases as well. So companies wanting to move money around different countries, through their banks or directly through a payment provider. So the use cases, to Chad's point, I mean, I think they can all be addressed by modernizing the infrastructure. And I do think that as CBDCs come on stream a bit more, and we'll talk about that more later, I hope, the role of the public sector, I think, on the design and implementation is probably going to grow. So this collaboration is sort of super critical moving forward. I'll stop there.
No, thank you, James. I think this increased role of the public sector is also very interesting. It creates interesting dynamics between them and current players. Tommaso, what are your thoughts on this? What does the decline in correspondent banking mean in the short term, and the role of these non-bank players?
Thanks very much, Katie Ann, for the invitation, for the pleasure of interacting with colleagues here on the panel. I agree with everything that has been said. And to start, I think that we heard from others the answer to the question in a sense of the role of the public sector. And the public sector, as others have said, is responsible for regulation to start with, right? Everything that has to do with AML, CFT, compliance, financial integrity, even certain standards for messaging, etc. That's very much a public sector role. And if you decompose the costs of cross-border payments, you will find out that compliance with regulation is a big part of the cost. We certainly don't want to get rid of regulation, but we want to make it easier to comply with. We want to make regulation more homogeneous between countries. And that is an important part of what the public sector can do. To answer your question about public and private sector roles and the question about correspondent banking, perhaps a good example is just to look at the linking of fast payment systems. I think that there's a lot to be drawn from that. There are a lot of lessons to be drawn from that. So when we make a payment between banks domestically, we have solved the problem of interoperability. After all, each bank issues its own liability. You use, HSBC liabilities, and somebody else in England uses whatever other bank's liabilities. And we solved the problem of interoperability by doing two things. We've given both banks access to a common settlement infrastructure. And we have given both banks access to a common settlement asset, which is very safe. And that settlement asset is called central bank reserves. And the infrastructure is called some form of, fast payment system. So we've solved the problem of interoperability domestically. Internationally, across borders, we don't have such infrastructure, and we don't have a common settlement asset, which is riskless and both are willing to hold. So what do we do? The private sector steps in, builds a bridge or many bridges, and asks for a toll to pass the bridge. And that's what correspondent banking is about. And essentially, payments are being intermediated by private banks that are taking claims against one another. They're taking risk and have to manage that risk, the liquidity, foreign exchange, counterparty risk, and getting rewarded for it. So what have central banks done? So there is a very interesting project that looks at, and this is done in multiple countries, looking at linking fast payment systems. So what does it mean? So the public sector is running these projects and is essentially building a market for correspondent banking. So it's also building a system to make messaging work across countries, to make compliance with regulation consistent across countries, or at least seamless, let's say. And then at some point, the two fast payment systems don't really speak to each other, right? At some point, you need correspondent banks to come in and provide liquidity, provide bids on the foreign exchange rate market, and that's being organized by these public platforms. So, what has the public sector done? Well, it's tried to make regulation consistent, compatible. It's tried to make messaging consistent and compatible, and it's organized a little market so that there's more competition between private sector players. But nevertheless, there is the involvement of the private sector. So I think that it offers a lot of lessons: building markets, building infrastructure, ensuring messaging and communication. That seems like a pretty good model for a public-private partnership. Now, of course, things change when you start to get into CBDC and the tokenization of assets, but I suppose we'll speak about that later.
Yes, thank you. But would you say that I suppose that it's the alignment on regulation isn't quite enough, or hasn't quite happened as well as it should have done with all the costs of compliance and all that sort of thing?
I think that's the conclusion, not just of me, but of the FSB report that Kieran was referring to earlier. There's a recognition that compliance still accounts for a large part of the costs, and that we can do better to make compliance easier and more compatible between countries. That's what some of the building blocks that Kieran was referring to are aiming to do.
Yeah. And I wonder if this is the reason why you have so many non-banks coming in to try and solve these issues. And I would be interested later to understand if some of the new technologies can help solve the compliance issue, which I think would be an interesting area to go into. But Kieran, let's come back to you first and look at how can you even supervise this kind of a new world of non-banks versus traditional banks? What have you heard in response to your targets on that, and how do you implement standards kind of more granularly on these two new different types of players? Well, old and new.
Well, it's actually something that the FSB has been looking at for certain types of non-banks, even long before the roadmap. So back in March 2018, the FSB published a report on the issues faced by remittance service providers and the difficulty they have in accessing the banking services, particularly correspondent banking that Tommaso was talking about. And this highlighted banks' lack of confidence in the supervision of RSPs. And it noted that in some jurisdictions, there may be a perception that a remittance service provider sector is lightly monitored and not effectively supervised, and that the banks feel a bit like that they're the pseudo-regulator for the remittance sector. And one of the things that was also mentioned about compliance issues, there could be weak compliance in certain jurisdictions with international standards, particularly those related to AML, CFT, such as the FATF recommendations. And there was a number of recommendations came out of this report, and one of them was the national authorities were recommended to assess whether their models for the regulation, supervision, as well as inspection of RSPs are effective and properly include a risk-based approach. So what we can learn from that is it's not just about the standards, it's about how they're implemented in the various different jurisdictions and the harmonization involved in the implementation of those standards. And one of the things that we have done as part of our roadmap works to date was to conduct a stock take of existing international standards, principles, and guidance relevant to the safe and efficient performance of cross-border payments. So this is building blocks 2 and 4 of the roadmap for looking at alignment of standards and where there may be potential gaps in those that fall under that, which includes in particular non-banks, and enhancement of implementation monitoring under building block 2, which is it's all well and good to put out an international standard if you're a standard setting body or an international organization, but are you making sure that different jurisdictions are adhering to those standards or implementing them, and how they are doing so? So the stock take was based on information we collected from issuers of such standards and guidance, and we also looked at public and private sector users of those standards. And we had a lot of bilateral conversations, and a virtual outreach event took place in July last year. One of the things that came out of that was the importance of a level playing field between banks and non-banks. And this was looking to make sure that entities involved in the same business activities and offering the same payment services are subject to the same or similar, so not necessarily exactly the same, rules and supervision. So what we call same activities, same risks, same rules. One major challenge is ensuring the application of regulation and supervision to non-banks is proportionate to the risk they pose to the financial system and to users. And part of that was to look at the fact that non-bank entities, to get away from this perception that non-bank entities engaging in cross-border payments are maybe less likely, or maybe perceived to be less likely, to have appropriate controls in place. For instance, as we've been talking about for AML CFT. So there may be issues about potential risks or risk management gaps within the financial system related to non-banks, and the concerns raised specifically about RSPs is a prime example of this. The second part of proportioning risks is to allow for the fact that non-banks play an important role, as you've mentioned, in cross-border payments innovation, and we don't want to stifle that. And the other part of it is that, as a third element, if the supervision is not proportionate to the risks that are posed by non-banks, it could have adverse effects on costs, and in particular on financial inclusion, because this is something that we've looked at as part of setting the targets, where non-banks in some markets can have a greater reach at a lower cost than banks have. So this is something that we want to be able to foster competition and innovation, and not to stifle it. So a further challenge in the coverage of standards is that implementation may not be consistent as we've mentioned before, depending on an individual jurisdiction's supervisory resources and also on their legal and regulatory framework that is in place in those jurisdictions. And challenges may also exist as countries and jurisdictions, and this tends to happen a lot when you have payment systems that are primarily built with domestic considerations in mind. They may have varying considerations and characteristics. So there may be differences in the origin countries where the payment is being sent versus the destination countries for cross-border payments. And a final challenge that I would like to highlight is the issue of the definition of non-banks. There is not a consistency. They may be defined differently in different jurisdictions. That doesn't matter when you're dealing with domestic. That is a major problem when you're dealing with cross-border. So this can, for example, impact the type of access non-banks may be granted to payment systems, which we consider such an important issue under the roadmap that it has its own building block 10, led by the CPMI, which is directly looking at improving direct access to payment systems by banks, non-banks, and payment infrastructures. So I'll stop there, Katie-Ann. Thank you.
Thanks, Kieran. We did actually have a question sent in earlier for you on this, and it was about what about the distinctions between emerging and non-emerging economies? How does that vary?
So if we talk about the targets that we set and in terms of the roadmap itself, it doesn't differentiate.
No, yeah.
So the targets are global, but there is for sure an understanding that different jurisdictions are starting from different points. So it's not necessarily a case that you're looking at as a whole advanced versus emerging markets, because some emerging markets are more advanced than others. So when we are looking at, for example, monitoring the targets, we acknowledge that there will be a certain amount of regional basically data that will be required to identify areas that are behind or lagging behind when it comes to, say, the cost or the speed or so on. And you see that already in the one target that is already being monitored in terms of data, which is, as Chad mentioned earlier, the remittance prices worldwide database for the cost remittances targets. And you can see that the overall target has not been met after all these years, but there are regions where there are much lower costs than others, and they're monitoring on a regional basis.
That's very interesting and useful, actually, for the audience to know. And Chad, on this trade-off, I think that Kieran referred to before, on balancing, innovation and regulation, you, I imagine, are always speaking to players in the markets, money movement partners about regulatory frictions and all these sorts of things. So I'm interested to hear your thoughts on what Kieran said, and also regulatory friction and their role in keeping costs high. I think this is a really crucial point.
Yeah, and since remittances have come up so much in discussion already, I'll try to tackle that question through the lens of remittances. Yeah. We're fascinated by digital remittances, and we've done some work to better understand the progress that's being made to improve the lives of migrant workers and their families back home, and really many countries for whom remittances are a bigger flow of funds than foreign direct investment. First, let me acknowledge that innovative money transmitters, whether they're established firms embracing digital business models or newer digital first firms working with newer money movement networks that reduce some of the frictions of correspondent banking that Tommaso was describing, this does seem to be having a measurable impact on aggregate remittance costs. In the most recent World Bank quarterly report for the fourth quarter, the global average remittance cost for a $200 transfer moved from 6.3 to 6.4. Now, as Kieran says, that's significantly higher than the target. But the news is better for digital remittances. The digital remittances index from the World Bank quarterly report decreased from about 5% in the third quarter to 4.64% in the fourth quarter. That's better. But the global smart average for Q4, reflecting the cost that a savvy consumer with access to good information could pay to transfer remittances, came in at 3.5%, a reduction from 4%. So that's getting much closer to the target. And this is great, and it aligns with research we in the Institute did earlier this year. We gathered data for digital remittances initiated with cards and found that the average cost in 25 key corridors was 3.89%. Okay, so that's not far from the target, but the more important figures are derived from the best costs in each corridor, since this really represents what a savvy, digitally equipped person could find. And the Institute looked at the best cost the user could find in the 25 corridors, and the average of these best costs was just over 2%. So look for a white paper from us, this summer detailing some of this. But what needs to happen to continue these positive trends? Well, we need to get everyone equipped to send remittances digitally, and we have to enable the cashless receipt of remittances in more and more places. Many remittances are now sent digitally from G20 countries, but they are largely still picked up in cash by recipients in low and middle income countries. And money transmitters maintain large partner networks for this cash out at receipt. And this adds overall costs that tend to be borne by everybody. They're just priced in. So expanding digital receipt is crucial, but not easy, because the receiver will need to receive funds in a method that they can spend in their everyday lives. So the private and public sectors need to work together to drive digital ubiquity and thereby enable a more digitally inclusive economy. Beyond going more cashless, money transmitters tell us that know your customer requirements, suspicious activity report thresholds, Office of Foreign Asset Control screening, and anti-money laundering and counterterrorism requirements are topics worthy of policymaker attention. Tommaso mentioned several of these. Now, going back to my response a few minutes ago, some of these topics are getting attention in focus area B of the roadmap. So progress here, as I implored before, is just critical. One last thought here: policymakers can also help the private sector introduce innovations more quickly and with less burden. The passporting of licenses, a suggestion from the World Economic Forum in its June 2020 paper on cross-border payments, was not directly addressed in the roadmap, but even increased consistency, if passporting is too much, of licensing requirements would help fintechs operate across multiple markets with less friction. We believe the private sector should prioritize creating products that offer better customer experience and enable more efficient transfers of money. But the public sector can help by reducing the barriers to market entry. Currently, with vastly different licensing requirements around the globe that need to be met, companies have to spend large amounts of time and money to navigate the different policies and requirements, and this slows the process and makes it more expensive to get to the finish line. So we think policymakers can especially help smaller fintechs bring solutions to market by streamlining licensing and bringing even more competition to cross-border payments. Thanks, Katie.
Thanks, Chad. I think the ball's in the public sector's court to start helping with these initiatives, and hopefully I think the UN target was set about 11 years ago. Hopefully we can see some even more progress. Although everything you've said, Chad, it sounds very positive, but yeah, we're far away from that the key target on remittances. We've got so many questions coming in now about CBDC, of course. Very hot topic. I'll let you know the poll results. So people are saying that that half and half think that CBDCs can solve existing challenges in cross-border payments. 42% said yes, 50% said too soon to tell. So that's quite telling. So let's move on to CBDC. James, I'll come to you first. You mentioned already that this is a role that the public sector could play, but can you just go into a little bit more detail about what a CBDC can offer and a stablecoin? CBDC in the long run is a type of stablecoin. What can it do to solve some of these challenges, and why? I'm interested to know your thoughts on why isn't it enough to just have increased fast payments or digitalized correspondent banking? Why have we gone into this CBDC world?
Yeah, thanks, Katie-Ann. When you talk about CBDC, there's definitely a baseline discussion around domestic CBDC. That's where a lot of the projects started from. And there are lots of different potential benefits around CBDCs that have been talked about. Financial inclusion is one that's talked about a lot. There's a lot of high-level buzz discussion around that in the industry. I think when you start thinking about cross-border, it gets a lot more interesting. And I think you may have seen from the work the Bank for International Settlements kicked off last year, where multi-CBDC or MCBDC is becoming a big topic. And in our discussions, cross-border comes up pretty much in every country that we're talking to and engaged with. I think there's a recognition that it varies country by country, different economies, but there's a recognition that cross-border payments is too expensive, too slow, all the things that we talked about earlier on the panel. I think the secret really is the truly digital nature of these assets. So whether it be a CBDC or a stablecoin, the digital nature means that you can do things, more efficiently and at a lower cost. Yep. You still obviously need liquidity. That's a big challenge. If you're talking about between the UK and the US, that's not an issue. But if you take every currency pair amongst the 200 or so countries around the world, right, and every combination thereof, there's not going to be enough traditional liquidity available in the market. So I think the use cases around remittance is a well-known one. Use cases around the business B2B side as well. Yeah. Specific to CBDCs, I think there's a lot of debate going on right now around what will the policies be around a national CBDC being able to be used cross-border, right? So one model is you could take a digital dollar and you can go to Paris and spend it, right? I don't know that the regulators in the Eurozone will allow that or not. So will there then be some form of FX essentially, right? To go, okay, I'm going to convert my dollar to my euro. So the possibilities are endless here, right? But I think it's going to come back to the policy side of the equation as to what will be allowed. Another example is, you've got this whole topic around privacy, right? So, this big topic within Europe and some other jurisdictions around, making sure you can make payments that are sort of non-traceable, right? They're similar characteristics you have with cash today. Well, what happens when you have one jurisdiction that sets the rules? Is okay, anything below, say, $100 can be anonymous, right? But in another jurisdiction, it's $50, and you're doing a cross-border payment. How does that work, right? So there's all these sort of super complex, different regulatory environments that Kieran touched on earlier that I think could slow down the progress. The other point I'd make, just picking up on what Chad said, I think the ability to have people to receive money and then keep it digital and then go spend it, digitally, that's going to be massive, right? That I think will be a big game changer. And then the other thing, I think the other great point that Chad made was around, regulators and policymakers sort of streamlining some of these, allowing the innovation to actually, move more quickly. So anyway, I think those are some of the key points. I think the balance between stablecoin and CBDC, that's another interesting one that we'll see how that plays out. Yeah. I mean, at the moment, central bank money is, less than 10% of the money supply, and most of the rest is commercial bank money. Does that translate into CBDCs and stablecoins, or, over time, will everything become digitized? Too early to say, but lots of potential there. And I do think this collaboration, again, between public and private needs to be higher if we're going to solve the cross-border payments with CBDC. Right? Otherwise, I think the private sector will solve it, with stable coins and crypto and other things.
Well, that was a follow-up question I wanted to ask you. Is there something that, a CBDC can do that a well-regulated private sector stablecoin can't do cross-border?
Cross-border it's a difficult one to say. I think by definition, a CBDC is like the ultimate highest quality asset, right? Because it's backed by a central bank. So for that element, no matter how well regulated a stablecoin is, there's still probably a slight difference in the perceived risk. I think CBDCs domestically have got some unique characteristics, right? You can be, there's been talk about using them for stimulus payments, right? Or making payments to people that are on benefits and having it so that they can only be spent on certain things, so that you can program the money to do certain things. It can be perishable. You can see how that could happen domestically. Cross-border, it would be more complicated to do that. I mean, what would be the use case where, say, the US government was sending money, for aid in Africa, and they were sending, I don't know quite how a CBDC would work in that environment.
Thanks, James. That's useful. Tomasz, I want your thoughts on this. And we've got a couple of attendee questions I want to throw at you and James as well. So your thoughts on James's points, but also a question from N10 Networks. Is it possible to remove pre-funding with CBDCs? I think James touched upon briefly, but don't we still need to pre-fund for cross-border? I think this question goes to the heart of the matter, which is actually there are some use cases for CBDC, but are we not left with some of the same challenges still, even with CBDCs?
Thanks very much. And again, I quite agree with the examples that James gave. And I also agree with Chad that being able to spend these digital tokens directly in the recipient country will be a game changer, because you no longer have the necessity to exchange into other forms of money. Nevertheless, let's go through some of the examples that James just gave. I think they're very good. So, first example is I have a US dollar CBDC, and I want to send you money, Katie-Ann, in the UK, and I send you that token. You can receive it in your wallet. I've just done now a cross-border payment. You have my money. But how likely is that to happen? Can you really receive it in your wallet? So the reason I can hold US CBDC once and if one exists, is because I've been probably KYC'd. The wallet issuer, whether it's owned by the central bank or it's a private sector wallet, has KYC'd me. They know who I am. They've been monitoring my transactions. They keep my data. And will you, as a UK citizen, be able to be KYC'd in the same fashion? Will you be able to hold my digital dollar? That is a big question mark. It's also a problem from the standpoint of currency substitution. The UK may not be so happy. I'm using the UK as an example, but the UK may not be so happy to have its citizens holding a foreign currency. Now, of course, you happen to live in a country where the monetary policy is relatively stable, there's trust in the domestic currency, but what if you didn't? What if you lived in a country with high inflation, with very volatile exchange rates? The government may not be so happy to have you being able to hold dollars so easily. To date, you might have had to stuff them under your mattress. Now you can hold them on your phone, and you can hold a very safe version of dollars on your phone, not even held in a commercial bank, but backed by the central bank. So it brings up all sorts of difficulties, right? This very simple idea of being able to, you can hold now my CBDC. So you probably need something in the middle, maybe a market that will exchange my dollar CBDCs for your UK CBDCs that you can hold in your UK wallet, since you've been KYC'd, say, to hold your UK CBDC, sterling CBDC. And who plays in this market? What are the market makers? Clearly, it has to be, at the end of the day, people who can hold, firms and market makers who can hold wallets in both currencies, who have been KYC'd and have licenses in both countries. That may be possible. And who runs those platforms, those markets? Are there multiple markets? Is there one that is established by the public sector or perhaps by the private sector under some sort of license? Those are some of the tricky questions. And then let's bring in stablecoins. Let's try to do the same with stablecoins. Let's just, for the sake of simplicity, assume that stablecoins are simply a tokenized version of bank deposits. That may well be the future of stablecoins if these grow sufficiently. The business model that seems to make more sense is not to have full backing, but to have partial backing, and while having to comply with more regulation. So let's just suppose banks want to get involved and tokenize their deposits. Then it might go two ways. One way is that these tokenized deposits might be exchanged in a market, but we haven't done anything very different then from the correspondent banking model. All we've done is allowed perhaps more competition, because we're making, instead of bilateral relationships between banks, we're centralizing these on a market. Another way this could go is to say, well, let's not deal with all of this diversity of liabilities. Let's since banks hold reserves in their domestic currencies, let's ask them to transfer their liabilities into reserves and to send those to the market. And essentially what you're doing is using wholesale CBDC.
Yeah.
And there, you could have a market for wholesale CBDC, and you're kind of back at square one, which is the MCBDC bridge model. Then you can do more things on this market, and we can talk more about that. But I just wanted to put this into perspective and give you a sense of where this may go.
And is DLT essential to that future, do you think?
No, not at all. Not at all. There's no reason for to use distributed ledgers. What is important is consistency of ledgers. You could have one ledger on which information is written. You don't necessarily need everybody to have access to this ledger and to have access to all of the information on this ledger. You need some sort of programmability. And if you want to do more on these markets, you probably need some level of encryption in order to be able to control the degree of information that is passed on. Imagine having some sort of FX possibilities on the platform. Imagine being able to run auctions, which might be very helpful for countries with less liquid currency pairs. Imagine being able to take in bids from individuals and showing the order book to other participants without divulging the names of the institutions putting in the bids. You would need some level of encryption to be able to do that, to control the information that you receive and make available to others. But as long as you have a consistent ledger, programmability, and encryption, you don't need to have this be distributed.
Well, that's very fascinating with all the blockchain players coming into the system. We've got a question, I think, more on the sort of retail CBDC cross-border angle, which, Chad, I'd like to throw to you, as well as just a bit of a overview of how you're involved in CBDC on the interoperability side. Because obviously, I know you settle a lot between your banks, and the CBDC would bring the public sector in. But also, sorry, a second question for you. Why is the notion of financial inclusion higher with CBDC versus issuing a prepaid card, which can be remotely loaded with fiat money? So that question and kind of your involvement in CBDC would be great.
Okay. As has been noted, nearly all central banks are looking into CBDCs, according to the recent BIS survey. And motivations vary between advanced economies and developing ones. The decision to issue a CBDC ultimately lies, of course, with nations and their central banks as they think about what problems need solving. You just mentioned financial inclusion being one of those possible problems. I've got some very smart colleagues at Visa Crypto and Visa Research who've been studying how to make CBDCs more useful should they be introduced. And they've been exploring ways to make CBDCs function offline, something that cash does very well. To make CBDCs and other digital currencies interoperable, and to make CBDCs usable in everyday life. December 2020, Visa published a technical paper where we proposed an offline payment system, OPS, protocol for CBDCs that allows a user to make digital payments to another user while both are temporarily offline and unable to connect to payment intermediaries or, even the internet. And OPS describes how a user can instantly complete a transaction involving any form of digital currency over a point-to-point channel without communicating, again, with that intermediary. In addition, the OPS describes the standards needed to ensure that funds cannot be double spent during offline payments. As for interoperability, focusing currently between DLT and DLT interoperability, Visa has proposed a set of standards and techniques through cross-border CBDC payment routes that we're calling universal payment channels. In this model, under a hub and spoke design, the UPC hub would interconnect multiple blockchain networks and allow for secure transfer of digital currencies. One could think of it as a universal adapter among blockchains. Of course, not every CBDC, as Tommaso mentioned, will use a DLT or blockchain network. And so this represents an active area of research. There are multiple concurrent international projects going on, some of them at the BIS Innovation Hubs. As for usability, it's key to keep in mind that adoption of retail CBDCs will largely depend on two factors: consumer use and merchant acceptance. As payment platforms and choices proliferate, central banks will need to explain to the public the value of CBDCs and why they are building them. Consumers will need to have a choice between payment methods and networks, enabling them to make use of the features. For driving adoption of CBDC from day one, it would be essential for CBDCs to be usable across a variety of payment networks, such as cards and instant payments, to offer both choice and larger scope for additional motivations and use cases. So, towards this end, Visa's focused on developing new infrastructure that can help central banks and traditional financial institutions come together and build simple, user-friendly services on top of new CBDC networks. Visa's CBDC payments module is designed to provide an on-ramp for CBDC to existing payment networks so that new CBDC networks can easily connect to traditional financial service providers through the payments module. The goal, of course, is a user experience that looks very familiar to how people pay electronically today. If CBDC networks are seamlessly integrated into your existing banking app, you would be able to use your CBDC linked card at checkout or tap your digital wallet, loaded with your CBDC funds and payment credential to pay securely at tens of millions of merchants worldwide. So it would be a familiar, trusted experience for people around the world. So my Visa crypto colleagues are excited to enter the next phase, which would be piloting and prototyping an actual use case with the payments module, which they expect to start doing this year. Now, you asked a question about financial inclusion. From my standpoint, a prepaid card might function perfectly well for people, and remittances received that way would certainly be accepted at millions of merchants. But as I just described with the payments module, if it's important to financial inclusion for a country to have CBDC out in the market, we would like to ensure that CBDC could still be spent the same way that prepaid card could, and that there would just be millions of merchant locations where someone can spend their digital currency.
Now, that's a really important point, I think, on adoption and consumer understanding that you raised before. We're running out of time, which is a massive shame, but I wanted to grab final thoughts on maybe James and Tommaso on sort of the wider geopolitical landscape and what this means in regards to CBDC. Are we seeing sort of a regional proliferation, and what does this mean for the system as a whole? And do you see this fragmentation continuing? James, I'll start with you first, if I can.
Yeah, I know we're short on time here. No, I think there are geopolitical discussions going on at different levels. The US is keeping an eye on what's happening in China, for example, right, and understanding whether if the digital yuan starts getting used more broadly outside of China, does that have any impact on the dollar as the sort of currency of choice for global trade? So big topics like that. I think more regionally, we're seeing in Asia, some of the emerging countries that we're working with are seeing the ability. They're looking to collaborate with their neighbours and other regional players. And I think that's how some of these multi or cross-border CBDCs will start. I mean, a quick example, we're working in Bhutan and the driver there is partly financial inclusion, but partly to leapfrog the technology to get into the best possible digital technology. As a wholesale, CBDC and cross-border, all part of the same strategy, right? And I think we'll see that. There's obviously the trading partners that they work with, and then the other thing I'd say real quick is, we're kind of viewing the CBDC implementation in a country as a platform for innovation. The basic sort of basic use cases around wholesale and retail as a cash replacement is sort of table stakes in our view. There are other use cases that the public sector will build, and blockchain can be quite helpful in as a platform for innovating. An example in Palau, we're looking at rolling out a P2P lending platform, a DeFi platform, on top of the CBDC platform, just as an example. But I will give Tommaso the last minute. I know we're short on time, so thank you.
Thanks very much. So in 1 minute, I think all I can say is that indeed, there is a trend towards deglobalization, towards economic blocks being created around the world. We've been vocal about raising this risk in our recent flagship publications. Part of it has to do with geopolitics. It's harder for any of us here around this table to snap our fingers and redress the situation even if we wanted to do it. It's easier for us to address the other reason why there might be more economic blocks, and that is ensuring interoperability of payments, enhancing cross-border payments. A seamless cross-border payment infrastructure is the basis for an efficient international monetary system. After all, it is based on the movement of capital and the convertibility of currencies. It all relies on a deep foundation of an efficient international payment system. And that is, after all, what we're all here working to try to improve. So thanks very much.
Thanks for that final word. And I can't believe, we went through an hour without going into depth on interoperability, but it's all relevant and it's all touched upon. But thank you so much for my panelists. Just to let the audience know, we have a 30-minute networking break now, but join us for our next panel at 1:30 UK time on data and digitalization. So some of the things that we didn't quite cover here, like data harmonization and fragmentation, we can explore in more depth at half 1. Thank you so much to everyone, and have a lovely rest of your day.
Thank you.
Thanks very much.
Thank you. Sorry we didn't get to the last question.
Thank you.